Hello all, Tony here. Well, we saw US stock markets end last week on a positive note, supported by soft inflation data that reinforced expectations of a rate cut at this week's FOMC meeting. Now, at the last FOMC meeting at the end of October, the Fed cut rates by 25 basis points, taking the Fed funds rate into a target range of 3.75% to 4%. Fed Chair Powell told reporters at the post-meeting news conference that the December rate cut was not a foregone conclusion, and the minutes of the meeting, which were released about 2 weeks afterwards, sounded hawkish. We saw the probability of a rate cut for the December meeting drop to about 30%. Now, after some dovish Fed speak and soft tier 2 labor market data, we're back up to around 87% price for a 25 basis point rate cut on Thursday morning. Now, we're expecting the tone of the press conference to sound similar to that October meeting, a little bit hawkish, but that won't come as a surprise to markets. Let's take a look at the charts of the Nasdaq and the S&P 500 to see where we are as we start this new week. Okay, starting with the daily chart of the Nasdaq, pretty similar chart to what I've shown you over the past few months. But last week we noted this false break lower did seem to be a bit of an inflection point for markets. And the reason we said that was it broke below that important support around 24,000 before finishing higher up around 24,240. Now, since then, we saw a strong rally, which has taken the Nasdaq up towards the 26,182 record high. And following this false break lower, we did move to a bullish bias, and we are looking for a break of this record high before a push up towards 27,000 into year end. Now, this could potentially be the end of a wave 5, but we'll wait to see how that plays out into the end of this year, early next year, before calling the end of that 5th wave. They can extend, as we've seen previously. Now, for the S&P 500, we're looking at a similar chart. We can see the rally from the Liberation Day lows, took the S&P up to this 69.20 high at the end of October, and then we've had a 3-wave pullback, a good sign of a correction, which culminated with this false break lower below support coming in around 65.50. We highlighted a number of times the importance of this support. It had a look below on the 21st of November, trading down to a low of 65.21, but it actually closed up at 6,600. So again, we're looking at a false break lower, similar to the chart which I just showed you on the Nasdaq. Now, following that false break lower, it's been pretty much more one-way traffic in the S&P 500 and the Nasdaq as we push up to a high of 68.95 last Friday, just falling 25 basis points short of this record high at 69.20. So the view remains that while we hold above this support area, coming in around 65.50-ish to 65.20, if you want to include that low, that things look pretty good for a push higher towards the 7,000 level into year end. Now, keep in mind that this week, we start to hit that very seasonally strong time of the year. It's around the 15th of December. So we're still about 7 days away, but you would probably start to err on the side of thinking that may start at the end of this week. So potentially what we may see is just a minor pullback in the early part of this week, and then that seasonally bullish time of the year from around the 15th of December is the catalyst which drives the S&P and the Nasdaq to fresh record highs into the end of the year and potentially into the start of January. That's all for this week. Stay tuned for more updates ahead.